This is Frank Islam, Chairman and CEO of FI Investment Group and your host of Washington Current Review, where we interview leading voices from business and politics and explore the topics of current interest that impact you, the viewer. Today, our guest is Mike Eisenberg, the Regional Managing Director of Wealth Management Investment for Wachovia Bank. I want our audience to know that Wachovia Bank is my banker, the good bank. Mike will be discussing issues related to economy and the banking sector. Before I begin my interview, I want to say Mike is extremely eloquent. He's a source of strength for all of us. Thank you, Mike, for coming.
My privilege, thank you.
Appreciated you taking the time to come and talk to us. Mike, the worldwide economy and markets have been highly up and down. You can see the stock market, pretty volatile, for over a year. For the benefit of our viewer, can you give us a brief summary how we got here?
Good question, Frank. And I'll do my very best to do it in a minute or so, although I'm sure books are going to be written about this for years to come. The way I would like to set the basis for answering this is really to look at the life cycle of a bubble, because that's really what precipitated this. So I'll make that very brief. If you look at the life cycle of a typical bubble, you'll see that it starts off with easy money, looking for growth opportunities, leading ultimately to a speculative phase, inflation of assets, and when that occurs, money ends up being pulled back, deflation of assets, and then to recover, there's easy credit again, and hopefully you don't start the next bubble. So if we try to fit in what occurred in the United States and throughout the world in this particular situation, what really occurred is that the United States was recovering from the last bubble, the technology bubble, had very attractive growth opportunities, easy money as a result of that. We're talking the 2002 timeframe. And at the same time, you've got a lot of other interesting forces around the world coming to play. For example, there's been the emergence of clearly global interdependence, emerging markets led by China, India,
Brazil,
other
Russia.
major, absolutely. And those countries were growing so quickly, there was a savings glut because they couldn't find opportunities to consume in those countries to absorb all their savings. The United States, with its housing attractiveness, was a great source for that. Now, overlay on top of that low interest rates at that time, and also as financial institutions in the United States were at the same time competing for those assets from around the world, they became lax in some of their requirements. The federal government didn't do as good a job in oversight. And at the same time, financial institutions, being innovative as they are,
they become too greedy, Mike.
That's really what it comes down to, Frank. So they created these instruments that nobody really understood.
Right.
And here we go. So you've got clearly the easy money, you've got the growth opportunity, you've got the glut, moving into those. So where we ended up with, to make a long story short, is the inflation of assets phase. Mm-hmm. And then you had the bubble pricked, and and it led to a variety of issues we're dealing with today.
Do you feel that we are on the road to recovery? If so, what could possibly derail the recovery?
That's a great question. I do think that the patient is stabilizing. I do believe we're on the road to recovery, but I don't think that we ought to expect that it's going to be a straight line to recovery, and I don't think we should expect anything other than a bumpy road to recovery, and we're seeing that now.
And how long that will last?
I wish I knew, but I do think I think we're going to deal with certain forces for years, and there are going to be some major forces. I do believe so. This will be a slower recovery, which ultimately will be healthier to cleanse the system out. The things you got to look out for, there are a lot of positives, whether it's monetary policy that still has a long time to work through the system, fiscal stimulus, housing is stabilizing, etc. Labor is still weak, and that's going to take time. You've got some other headwinds as well. The consumer is a major headwind, but at the end of the day, you'll want to look at some other major possibilities that could derail us, and I hope China stays strong and the other countries that you've talked about. Also, interest rates need to stay tame, and inflation, and hopefully we'll get out of this sooner than later.
Many investors are concerned that the enormous infusion of government money to save the financial system may create hyperinflation. Do you agree with that?
There is the possibility, Frank, but I do think, because it is a raging debate among economists right now, but I think the question the answer ought to really focus on When is the right time to put those tools in place? The Fed has the solutions. They do have the tool set. They've got the options to do it. It's going to be, I think, a matter of timing, and that's going to be the issue. So I don't think it's can they do it, will they do it? Now the thing again is, I don't think we have to worry about hyperinflation anytime in the near future, because we do have some of those major deflationary headwinds, such as the impact of labor, which is going to carry through for a while. Housing is still stabilizing, as I mentioned, and other forces that are going to keep the economy relatively slow and not inflationary or out of alignment from an inflationary perspective for years to come, probably.
It sounds like the crisis has caused some structural changes to the economy, correct?
Yes, I think so.
Could you spend a few moments giving some example of those changes and how the future may be different?
Yeah, thank you. I think that a couple of possibilities that come to mind in terms of a change in the structure of the economy, and I referenced one obliquely before, is the consumer and consumer attitudes. I think the consumers learned a very harsh lesson, and I do think that they're going to think twice about spending freely and taking on a great deal of leverage. They're going to work through deleveraging first, and whether it's not buying that appetizer during dinner or not buying that second house.
We have to change our culture and our behavior.
I think so, and that's
here.
Yeah, exactly. I just read a very interesting research report this morning, and it equates to the predictability of GDP, gross domestic product, and it suggested that 53% of GDP can be attributed to consumer expectations.
53% of GDP.
Right.
I thought it was the consumer spending.
Well, that'll lead from consumer expectations.
Okay.
The other thing, of course, we have to deal with is a change in government. Government in the United States is getting bigger, and I think that's the way it's going to be for an extended period of time.
Especially with the Democrats there in the power.
Well, I'd like to share my views with you more freely, but yes, I do think that that's likely to be the case.
So as you mentioned earlier a couple of minutes ago, and I've seen the reports from Washington Post that the housing was a major catalyst in this downturn. Do you believe the housing market is improving, as the Wall Street Journal has reported several weeks ago?
Of course, we all believe everything we read in the Wall Street Journal. But having said that, I do believe, no pun intended, that a floor is being created under residential real estate. If you look at new home sales, pending home sales, existing home sales, they all seem to have stabilized. That downward spiral seems to be over. So let's hope that we build a solid floor. That doesn't mean the party's over. That doesn't mean that there won't be more weakness. I don't know if you knew, Frank, but pending home sales have been up the last 4 months in a row nationally, and even new housing starts have been up, I think, 47% over the last 4 months. But because labor and because you can expect employment to continue to be weak, you'll probably continue to see continued foreclosures for a while, weakness in the housing market for a while, and as a result, housing prices will probably continue to decline at a slower pace for a while, but I think we're setting that floor.
So we're headed in the right direction?
I think so. I think it'll just take some time.
So there is a light at the end of the tunnel? I
believe so. Yes, I do.
Investors have lost a lot of money, including myself, as you probably know, in the stock market over the last year.
Yes.
And those are some of the lessons undoubtedly that we have learned from that. What are some of those lessons that you want to emphasize to investors?
Well, I've been doing this for a long time, and probably have some gray hair and less hair to show for it as a result. But having said that, my experience is that when we deal with these kind of extreme market conditions, whether it's bear market or bull market, is that fear and greed really do drive the market. And I find that as the market goes up, and as it goes up more aggressively, investors change their risk profile and they become more aggressive. Conversely, the market goes down and they become obviously more pessimistic and they change their habits. Now, what investors should do, and this is very hard because this is an emotional business and we're dealing with money, et cetera, is that my recommendation is we need to have a disciplined, structured, objective asset allocation plan. Something that looks at your time horizon, something that looks at your income needs, something that looks at your taxes, and stay with that, something that you're going to stick with in market conditions. Now, one very important key, I think, to this asset allocation plan, which doesn't have to be super sophisticated, depends on the individual, Frank, as you know, but is to know what we call at Wells Fargo Wachovia, knowing your number. Okay?
Right.
And that means And it's funny, I just read another article today about the CIO at PIMCO reinforced this very point, so I'm glad he agrees with me.
Okay.
But anyway, knowing your number means having a clear understanding of the liquidity needs that you have for your mortgage, for your house, for your vacations, whatever. It's your safe money, and do not put that money at risk.
You're talking about expenses, day-to-day expenses.
Absolutely. Don't put that money into the market.
So
That's your safe money.
So you protect your principal.
Absolutely. Yeah.